Okay, first up is the long trade blueprint. Okay, the first thing is we need to define some of the terminology used in the blueprint. First, the LL2, that's the lowest low of the past 2 days. The LL5 is the lowest low of the past 5 days. The LL40 is the lowest low of the past 40 days. And the LH5 is the lowest high of the past 5 days. The ATR20 is simply the average true range of the past 20 days. And the swing low is any low with at least 2 higher lows than the swing low day low and 2 higher highs than the swing low day high on both sides of the swing low day. Now, as we get into the blueprint and the chart application of the trading rules, you'll see these terms come to life. Now, you might think about the setup rules as defining a W pattern that you can visually observe on the price chart. And if you look at point 1, 2, and 3, they form what looks like a W, with point 3 being lower than point 1. So keep that in mind as we go through these setup rules. All right, first we're going to apply the setup rules to a typical daily Forex candlestick chart. And these setup rules then will alert you to get ready to enter the market. We're going to apply these rules to the green candle that's labeled setup day to see if indeed that day satisfies all of these rules. So let's start with A. That's the lowest low of the last 5 days from and including the setup day equals the lowest low of the last 40 days from and including the setup day. And that indeed would be point 3 as labeled on the chart. So if you count back 5 days from the setup day and 40 days from the setup day, you will find that point 3 is indeed the low of the last 5 days and the low of the last 40 days. So that's condition A. B, the point 3 low is less than a swing low, which is point 1. Now, point 1 has to be a swing low, which is, as defined earlier, a low who has at least 2 higher lows on either side and 2 higher highs on either side of the swing low day. And by visual inspection, you can see that that is indeed the case. Now, a very important condition is C here, where the lowest high the last 5 days from setup day, and that's labeled on the chart with the letter C, that lowest high the last 5 days has to be greater than the point 1 low minus 1 average true range 20. Now, what does that mean? If you take the point 1 low and subtract from it 1 average true range, you can easily plot that with any good trading software. Pick off that point, subtract it from the point 1 low. As long as the lowest high the last 5 days is greater than that level, then condition C has been met. Okay, then we have D, the 5-day exponential moving average turns up, as shown on the chart with the letter D. And E, the setup day close has to be less than the 18-day moving average, which is the blue line plotted on the chart. So that when A through E have been satisfied, you then have a valid setup day. All right, now once we have the setup in place, we can look at the entry and exit rules. First, the entry order. We're going to simply buy at the market on the open of the day after setup day. And that's signified on the chart with the green B arrow. Now, for the entry day only, we're going to use an initial stop to sell at the point 3 low, stop close only. Now, what that means is if we enter the market on entry day and the market subsequently drops, in this example, and closes below the point 3 low, then we're going to immediately exit the market on the open of the next day. Now, that seldom happens, but what does happen on occasion is after getting into the market on entry day, it will trade lower temporarily, but then close higher on the day. And so we don't want to get stopped out prematurely if that happens. Now, after the entry day, we're going to use the follow-up stop to sell at the lowest low the last 2 days times 0.999 stop. That's a fancy way of saying we're going to take 1/10 of 1% of that lowest low of the last 2 days and subtract it from the 2-day low. Now, that stop will apply to the entire position or a half position if the profit target exit has already been hit. And concerning profit target exit, what we want to do is exit half the position at the entry price plus 1 average true range 20 with a limit order. And we're doing this for a couple of reasons. One, we take a real nice profit immediately. We take half the position off the table, so that automatically cuts whatever risk there was in the trade in half. And we're applying the LL2 follow-up stop to the remaining half position, and then we update that at the end of each day and move that stop up so that the market can go as far as it wants to go on that second half position. And in this example, it gets stopped out at the red S arrow towards the top of the chart, that big red candle, because it took out the lowest low of the last 2 days. So you can see how moving that stop up every day immediately reduces the risk in the trade and then zeroes it out altogether so you have a free trade situation. And then it lets the profits run as far as they want to go, locking in profits day after day after day until finally the trade stopped out. It's a very, very powerful exit strategy that allows you to take full advantage of what the market has to offer on each and every trade. Okay, next I'm going to teach you the short trade rules for the pip reversal method. And these are pretty much the reverse of the long trade rules. First, the definitions. The HH2 is the highest high of the past 2 days. The HH5, the highest high of the past 5 days. And the HH40 is the highest high of the past 40 days. The HL5 is the highest low of the past 5 days. The ATR20 is the average true range of the past 20 days. And a swing high is any high with at least 2 lower highs than the swing high day high and 2 lower lows than the swing high day low on both sides of the swing high day. The setup rules. Well, in the case of a short trade, what we're looking for is an M for money pattern. And you can see that on the chart with points 1, 2, and 3 tracing out an M pattern. Now, it's not just any old M pattern. It has to be one that meets conditions A through E. So let's go through them. A, the highest high of the last 5 days must be equal to the highest high of the last 40 days. And if so, that would define point 3. B, the point 3 high is greater than a swing high point 1. And by visual inspection, you can see that point 1 indeed has at least 2 lower highs and 2 lower lows on either side of the point 1 swing high day. And then C, the highest low of the last 5 days, and that is signified by the letter C on the chart, is less than the point 1 high plus 1 average true range 20. And so if you were to add 1 average true range to the point 1 high, you would find that the highest low of the last 5 days from setup day is easily below that level. And then the 5-day exponential moving average turns down as of setup day. You can see setup day there highlighted on the chart. And if you look at the brown exponential moving average line, you see that it turned down on that day. And then condition E, the setup day close has to be greater than the 18-day moving average, which is the blue line. And clearly it's well above that average. So all conditions A through E have been met, qualifying the red candle that's signified as setup day on the chart is indeed a valid setup day. And this then alerts you to get ready to enter the market. So once we have a valid setup, then we would enter the market by selling short at the market on the open immediately following the close of the setup day. And you can see the entry day is signified with an SS red down arrow. Now for the entry day only, we're going to buy to cover at the 0.3 high on a stop close only. That's our initial stop. And again, that means if on the entry day the market suddenly reversed and traded higher above the 0.3 high and closed above that high, we would exit the trade immediately on the open of the following day. Now that seldom happens. What does happen on occasion after entering the market, it can trade higher above the 0.3 high only to reverse and then close lower on the day. So we would not want to get stopped out prematurely in that event. And then following the entry day, for every day thereafter, we're going to use the follow-up stop to buy to cover at the highest high of the last 2 days times 1.001 plus the spread on a stop. Again, this means that we're going to take 1/10 of 1% of the 2-day high and add it to the 2-day high and then add the spread. The reason we have to add the spread for you newer traders is in Forex, when you buy on the ask price. When you sell on the bid price. And so here we're buying to cover, so we're going to be buying on the ask. So we need to add the spread into this calculation. Now this follow-up stop is updated at the close of every day. So you're continuously tightening up the stop. First, zeroing out all of the risk in the trade, and then eventually locking in more and more profit. And if you just visually look at the chart example, you can see going forward that on each subsequent day's close, you would be dropping down that follow-up stop very, very quickly. And eventually you're stopped out where the green arrow pointing up says BTC, buy to close, at a very, very nice profit. Now, the way we handle these trades, though, we don't know if the market's going to drop like that or not. So what we want to do is use a profit target exit and exit half the position at the entry price minus 1 average true range 20 on a limit order. So that if the market only drops a little, at least we still get a nice profit and we protect the remaining half position with that follow-up stop. So no matter what the market does, this strategy, this two-step exit strategy, maximizes your profit potential. So there you have it, my complete pip reversal method. The same method many others have paid a value of $500 for. Now, it worked way back in 2007. It's been battle tested over the past 5 years, and it still works today.